falling into poverty. We at NSWAST
of India. Mr. Vivek Tiwari, MD and CEO of Satya MicroCapital Limited. Mr. Manoj Sharma, MD of Microsafe Consulting. Mr. Sudhir Madhavan, President and Head, Retail Assets, Jana Small Finance Bank. Mr. Subhrangshu Chattopadhyay, Director Business Development, CRIF, Highmark. Now I am requesting our moderator to start the session, and we are welcoming all the dignitaries here.
Am I audible? Welcome to this session. We are here to discuss new regulatory framework for microfinance, MFIs experience and role of SROs. Before we begin, let me just briefly touch upon as to why we needed this regulation. NBFC MFIs were the pioneer in providing microfinance in the JLG format, that is Joint Liability Group format, which was based on Professor Yunus Grameen Bank model. Now, over a period of time, we have seen other lenders have also grabbed a pie in this market. Lenders like mainstream banks, high street banks like SDFC, ICICI, then of course Bandhan, because of its transition into an universal bank from microfinance. Then we have a small finance bank, other NBFCs. So these entities have grabbed a significant pie in this market, so much so that the share of NBFC MFI's loan to the total universe has come down to about 34%. But the issue here is that there are several kind of lenders, but earlier the regulation was not uniform. So that was a challenge. So RBI had to address this. So we are here with this harmonized regulation. There were challenges in it because this regulation talks about mapping household income, which is for the first time perhaps RBI has asked all the lenders to do that. So that's a big challenge. I will first invite Mr. Tiwari, if you can take us through your journey, the challenges, how you address the challenges and the journey in the last 8 months or so.
Thank you so much, Atmadip. After new regulations, I think on one side it was very welcoming that the regulations are almost uniform, and where it was very tight regulation on the NBFC MFIs only. On 34-35% portfolio, the number of restrictions were there, and on rest 2/3 portfolio, it was almost no regulation was there. So, but after new regulation, the first challenge was to how to adjust with the household income calculation. That is the one thing, because it is not reflected in the credit bureau report, and it is informal income and based on the declarations, and that declaration from a particular borrower, it is not fixed, means from morning to evening or from today to tomorrow, they are having different income to say. Means you have to calculate in a right way and try to understand what actual income is. It's always very challenging, but we know the segment. We are dealing in the particular market since last more than 2.5 decades. So definitely, actually we are able to understand the average income of the particular set of the customer. It is not a particular individual customer, but particular set of customer with which activity they are involved, what they are doing in their businesses, and how. And for the expenses, we are more dependent on number of family members, how much number of family members they are having, their school-going children, and also their other immediate liabilities. So regulation is quite favorable, quite challenging to capture the informations right in the bureau reports. And the one more challenge is that for many NBFCs, even they don't capture the EMI of their loans. In the credit bureau report, we see the indebtedness of the loan amount, number of loans, their indebtedness, but they don't inform exactly the what EMI they are charging. So to calculate the FOIR, that is another challenge. For these things, we just investigate further from the SMS of the customers, from their sanction letters of different other institutions, and it is a little bit tricky, but whenever the changes are there, changes are for the betterment, for the good, it will take some more time, but things will be adjusted. One challenge as an industry we are facing, that is on the qualifying asset side, that earlier it was 15% non-qualifying part was allowed, but that 15% was higher than current 25%, because our bank balances and other investments, it is also part of entire asset. So in the last quarters, last months, sometimes there is a heavy disbursement from banks are there, and we keep certain funding in our account for at least 2 months. Liquidity we keep in our accounts every time. So we are, as an industry, we are trying to adjust, and we have approached our regulators again, and hopefully some favorable guidance may come over a period of time. But regulations are very welcoming, and at least within the same game, we all are playing with the similar rules, and we are as a MFI industry, we proudly claim that we are custodian of that particular segment, and we understand that market much better. And this household income issue was from day one, means when we started our career, 50,000 rupees annual income will be the maximum limit. That was from our declaration. From there we have seen the 300,000 rupees or 3 lakh rupees declarations. It is giving a headway. Opportunities are more, but I can discuss in later session, otherwise I can discuss here.
I would like to ask you another thing, that SROs played a quite important role in this transition. Yeah. Do you think they need to do more, or you are happy with whatever they've done so far?
As an SRO, we are, I am also on the, I am vice chair of MFIN. So as a SRO, we are not regulator. We have to collect the data, we have to put the data in a right way and educate our members in a right way. In last 8 months, the way Sa-Dhan and MFIN, we both have actively worked on the ground and tried to train to make the regulations more understandable to the common loan officers on the ground. I think that is commendable, but definitely continuous rigorous training is more required for the field staffs and branches, so that they are able to understand in a right way, and while doing the credit appraisals and sourcing the loans, they can they never forget the regulations. Means we are seeing the increase in the rejection rate from the bureaus. Earlier, multiple loans, just like gold loans, CRIF credit card loan, and many other loans were not reflected in the microfinance bureau. But now it is 360-degree bureau. Even we are seeing that some 10-15% customers, they are having multiple other loans. Auto loans are there, or two-wheeler financing is there. Now everything is coming in that particular basket. So it is playing a very, we all have a very important role to play now.
Right. So there were challenges, and Mr. Tiwari is saying that he has passed the test so far. But here is the examiner with us, CGM RBI. So sir, how do you see the process evolved? Are you happy with the lenders, how they progressed in this journey?
Thank you, Atmadip. See, let me come to your question directly. When we issued the guidelines initially, our intention was to implement those guidelines immediately. But then we received a lot of representations from lenders that they need to modify their processes, they need to set out policies, get board approvals, even technology changes they had to make. So we extended the guideline, the deadline to 1st October. So in that sense, it's still early days. But we are seeing some indications that lenders are, putting in place their changes, their policies and all. For one, the rejection rates, as has already been told, it went up despite increasing the household income criteria. Now, we expected that, since we have increased the household income criteria by 50 to 100%, we thought that, not only rejection rates will come down, the average ticket size will also go up. But on the other hand, we saw that rejection rate has gone up and average ticket size of loans has come down slightly. So probably that is an indication that not only new processes are being put in place, even the lenders are becoming more circumspect, circumspect in assessing the household income. Now, household income issue has been raised everywhere. Right. This criteria was there already. It's not a new regulation. I mean, lenders are expected to do it even without regulators nudging. It's only for the first time that we have given some sort of indicative methodology how to do it. SROs have been asked to work out their templates based on which lenders can decide their method how to work out assessment. So, in that sense, probably the assessment is being done more rigorously. So probably that's the reason why ticket size has gone down. So I think, while it is still early days, but the indications are that, it's working.
As I talk to different captains of this industry, I understand this, they have captured 90% of the data so far. So how do you think that can impact the borrowing pattern?
I'm not sure, what kind of data you're talking about, or like,
no, household
maybe
income data. They're
okay.
They're extrapolating the 90% to 100%. So, kind of.
See, the way I understand is, the best way to assess the household income would be you just have a field visits, have a look at their physical assets, then try to link it with their declared income, and then you verify it with whatever sources are available, and that's the fundamental principle based on which the templates are working. Now, in rural areas, assessment of household income has never been perfect. I mean, we all are lenders. We can discuss these things in closed walls. So assessment of household income in rural areas, especially, has never been perfect. I mean, it's a cash society. People are having multiple jobs, things like that. So, while the current guidelines are a step forward, it's an incremental improvement over what we had earlier. My hunch is that it may not be 100% correct. But then, one has to work on best effort basis.
Right, absolutely. Let me turn to Mr. Sharma from MSC. At the heart of this RBI regulation is customer protection. What do you think about, so far your experience goes, how far have you achieved this?
So, if you look at customer protection, there is this whole gamut of SROs, and of course the microfinance institutions have their own customer protection guidelines and so on. But if we were to take a step back and say, okay, so why did we start with group lending in the first place? Yeah? So group lending basically started because we were starting with smaller loans. There were 3,000 to 5,000 rupee loans in those days. It made no economic sense to be able to give those loans as standalone loans to the women who wanted them. So it made sense to form groups, to have group guarantees, to make it as a convening forum, so that there was a whole economics and a social sort of cohesion to that group that enabled loans to be given. The moment we moved into the 50,000, 100,000, 75,000 loan brackets, it makes a lot of sense to do some sort of an individual assessment of the client's cash flows in terms of the business that the client is running, and also the household level assessment. So in that sense, even looking at it from a client point of view of the client, in terms of the regular feedback we get that, okay, now this pocket is overheated because we have lent more to clients in that pocket. At least the regulations now allow us to be able to do some sort of an assessment of what the household level income is. One can always debate that will it be really done and will it be done on paper and all of that, but we need to get started somewhere, and I think regulations are pushing the microfinance institutions to say that do it for the sake of your clients, but also do it for your own sake. In the sense that unless there are sustainable institutions, how do you run, unless there are sustainable models? So I think even from a client protection perspective, the first thing is my client moving on to a track where she will get over indebted? How do I sort of prevent that from happening? I think some form of assessment is needed. It should have happened on its own, probably 5-7 years ago. That it has not, I think the regulator has stepped in and said, probably this is the route you need to take. I think personally I feel that on this track we should anyway move, because the loan sizes are now at a level, the technology is at a level where I can do individual assessments. It is possible. Even though I fully admit that the client does not have that sort of a digital footprint. But who will create that digital footprint? It is for us to create that digital footprint for her, so that that assessment is enabled, so that she also can access better financial services at better terms from other institutions. I think it's all very positive as far as I see.
Right. We have with us Mr. Chattopadhyay, who will bring to the table the experience of credit bureau. You have now two sets of data. One is credit data, and now we have the lenders are submitting this annual, household income data. So do this data set allow or give us the opportunity to explore the over leveraging or the indebtedness of the market?
So, first is that the coverage of the submission has improved significantly. So clearly that is the first positive sign. When you look into the credit bureau, you look at two things. One is what is my fill rate and what is my population of default value in that. So we've seen the fill rate go up and the population of default value go down, which means that the processes that the lenders have put in place, they are resulting in discrete values. The sanctions, of course, were suppressed in Q1 of this year because of the process changes that needed to take. They have picked up. They have definitely picked up. So if you really look at it, about 3 crore loans got done in primarily in Q2. Very interestingly, the percentage of new to credit population that is coming in the enquiries has also increased. So it's in some sense that is also a desirable directional movement. Yeah. If you also look at the application to approval ratios, they have come down. But if you sharpen it further, it has come down primarily because of FOIA that is coming from the Consumer Bureau and not delinquencies coming from the Consumer Bureau. So directionally there are a few things that are saying that in the medium term, at least there are possibilities for causal effects to emerge. The only thing that we don't have the possibility to comment on now as a credit bureau is what is the impact on the new book because of behavior that was already prevalent but was not examined. So that will take, in my view, another 6 to 9 months for us to say that whether there's a possibility for a strong correlation, number one. Number two, is that correlation regular correlation or an inverse correlation? And we've seen this precedent actually. When demonetization came in, after demonetization, you actually had two very distinct books. One was a new book, the other was an old book. And to establish those, you need to give this portfolio about 6 to 9 months. But few good things, absolutely, the data is saying few good things.
I would like to ask you more about household income. The lenders are feeding in the data. Do you find any anomaly in this data set? Because borrowers are mutually exclusive.
So yes, see you. So if you actually trend the reported income for a borrower, you will find an operating range. I'll put it that way. So you will not find a single borrower who lender one has rated over here and lender 3 has rated over here. You will find an operating range primarily for a borrower. Now, even the income data trend that we have today is a mix of pre-regulation reported income and post-regulation reported income.
I see.
So
Okay.
you have to, and the post-reg reported income, that population will only increase with new disbursals. So as that comes in, then you have a new baseline for what is an operating range. And then you can say, on this new baseline, this was my FOIR at sanction, and this is how the different FOIR ranges are translating either into delinquency or renewals.
Let us get a view from small finance banks. Mr. Madhavan, has this regulation changed the way your bank performs, or has life changed for you after this?
Definitely, yes. First, let me congratulate Sa-Dhan for organizing such a good conclave focused on powering for the women. Definitely, yes. Let me go brief back to the regulation first. The first time I think we have a philosophy-based regulation instead of a rule-based regulation. And that's a big change what we have. The second is, historically we have been doing indebtedness as the criteria for selection of a customer. Now it's going to be repayment capacity of the customer. And that completely changes the outlook. And which is why Mr. Tiwari told, when we actually go down to the repayment ability of the customer, the rejection rate actually shoots up. Initially, we always used to work at 1.25 lakhs. He's got a gap of 30,000, we give a 30,000 limit. We never used to look at the repayment capability. That's changed. As a small finance bank, we have PSL requirement, which was rural was 1.2 lakhs of income and urban was 2 lakhs. Urban was 2 lakhs of income and rural was 1.2 lakhs. It actually gives me much more leverage when the income goes up to 3 lakhs. I'm able to get more customers under me, under this microfinance criteria, because we still have to maintain the PSL of 75%. As the income goes up of 2 lakhs to 3 lakhs, we as a bank can offer multitude products to these customers. When at 1.2 lakhs and 2 lakhs, we are very hesitant to offer differential products to these customers. Now we are entering into a segment of two-wheeler, we are entering a segment of three-wheelers, we are doing micro-housing loans to these customers. So as the level increases, your product differentiate, you can offer differential products, you can offer differential treatments, and that's actually helped the small finance bank part of it. Second, for the small finance bank, we are basically a microfinance who has become a small finance bank. So DNA still is of a microfinance company, but we can offer products on both sides of the balance sheet,
Right.
which an NBFC or MFIs can't do it. And we historically have seen that a cycle 2 loan or a cycle 3 loan, when the customers become more and more confident about themselves, they start saving also. You always see a customer at cycle 2, cycle 3, when the lady knows that her revenue stream is fixed, her income is, she knows her income, she actually even starts saving. Cycle 1, cycle 2, it's difficult to save, so we still continue with the zero balance accounts, but we see that cycle 2, cycle 3. And that's how the small finance bank still gets benefit from these regulations.
Have you raised interest rates after this regulation?
We haven't raised interest rates after these regulations. It's keeping the same as old.
Okay. So that is a very interesting part of this whole gamut of the things, because RBI has removed the lending caps on NBFC MFIs. So immediately after that, several MFIs, NBFC MFIs have raised in lending rates on an average of 150 basis points. I know some of the lenders have increased their rates by about as much as 450 basis points. Some lenders are charging now about 28% per annum, which is higher than, significantly higher than the median rate pre-harmonized regulation. So, Mr. Sharma, does it make you a little bit uncomfortable as a regulator?
That's a very interesting question, Atmadip. See, there are 2 or 3 facets to this interest rate scenario. First is, even if you don't do anything, even if you don't raise your interest rates, under the new regulation, there will be an uptick of maybe 1 to 1.5% of interest rate, because now we have all inclusive interest rates. Earlier we did not include processing charges or insurance charges in interest rates. Now all inclusive interest rate will show all that. So that itself will lead to at least the headline number will increase by 1 to 1.5%. That's the first reason why you see across the board increase in interest rates for all entities. When you compare their interest rates pre-regulation and after regulation, there will be some increase. The second very important reason is, when the regulation came out, most of the lenders, they were already coming out of COVID. There was a lot of stress in their credit books, and obviously their credit costs were high, and so that led to sort of increase in interest rates. And then third, which is very important and not really in the control of lenders, interest rate cycle itself has moved up. It's not really very appropriate to expect that in increasing interest rate cycle, lenders will reduce the rates. That's not going to happen. So probably in the near term, we may not see reduction in interest rates, but I have a feeling that as the competition increases, and not only competition increases, there is more transparency in the interest rates. The borrower, we are trying to make him more aware. So once the borrower is more aware, there is competition, and now we have prohibited prepayment penalties. So the borrower is more aware. He can freely move from one lender to another lender, and then there is competition. So probably in the midterm, there should be some reduction in interest rates.
In the regulation, policy regulation, RBI used a term that interest rates should not be usurious. How do you define usurious?
I knew this is going to come. Okay, when we were drafting the circular, we had a long debate whether we should use this word. We are very aware that this cannot be defined. You find any definition, any dictionary, there won't be any definition for it. But let me tell you, this is a very contextual and subjective word. We cannot assign any numeric value to it. We have to decide on case-to-case basis. Now, there cannot be one size fits all kind of thing. It depends on a lot of factors. Primarily, it will depend on what is the cost of funds for the lender. Now, obviously, we cannot use same number for, let's say, HDFC Bank or some small-sized MFI. There will be differences in cost of funds. There will be different operational costs. There will be different, geographic areas where they work. So it's not going to be possible to have a one size fits all kind of definition. But having said that, since I already said that this is a contextual and subjective word, we can surmise in a particular case whether the entity is is charging usurious charges or not. Now, just to give you one example, probably we have listed that in our circular also. If we see the names for this particular entity compared to its peers, similar kind of peers, or in case of banks, if we see very unusually high names for this particular portfolio of loans as compared to other portfolios. So probably we can, surmise that they are charging very high rate of interest. But then obviously, it will be a subjective judgment, and it's a supervisory judgment. Our supervisory departments, they will look into it. In fact, they are collecting interest rates charged by various entities across geography. They will be keeping an eye on that. Apart from that, in our circular itself, we have asked SROs to, sensitize their members to not charge usurious rates. So probably, it's a long answer, but that's the only way I can answer it.
I would like to ask Mr. Sharma, when you talk about usurious, a particular notion comes to mind, that is informal money lenders. As microfinance market expanded, did they change their strategy to survive? What is the situation on ground?
So, I mean, we, we kept hearing that even money lenders have moved to creating groups and, and trying to adopt some of the practices that microfinance adopts. So I think those things goes on, but the key question is that is the money lender out of business? Yeah. So that's unlikely, that's not the case today, and that's unlikely to be the case today. If you look at a hugely penetrated market, let us say like Bangladesh, where microfinance sort of is really, deep tentacles. You have some very, very large institutions there, very respected institutions there. It hasn't gone through the cyclical trends that we in India face, but one can say that that's because of our growth. Has the money lender really gone out of business? Not really. Yeah? And then, in some senses, we should ask ourselves this question, that why is it so? Why is it that the money lender in the villages that I am working in as a microfinance institution is not out of business? And I think the key reason is that we once were talking to a client of a microfinance institution, and we said, okay, so if there was one thing that you wanted out of this MFI, what would that be? And the lady said that, can you give us an emergency loan? Somebody is sick in the family, there is a sudden need. I need 2,000 rupees. Where do I go? I need to go and knock on the doors of the money lender. And they laugh at us because they say that, you might borrow from anywhere. When you need it, you come to our doorsteps. So I think as an industry, we really haven't got that product. Even if the woman has taken 6 loan cycles and has repaid, if she needs that 2,000 rupees in the middle of the night, she has to go to the money lender. Today, so the question for us is that if we are able to do a better assessment of this client is pitching up at our doorstep every week, every fortnight, every month. We have her credit history. We know how her behavior has been. Can we give her the financial products that she needs? Yeah? Rather than at the moment, we give her what we have. So as I say, microfinance is the last bastion of supply-driven delivery of services. Yeah? We don't really have the client in our focus. Till that situation continues, the money lender will tweak his or her business, but is unlikely to go out of business.
Right. Mr. Madhavan, at one point, NBFC MFIs used to charge, the median rate was 24%. Now banks, mainstream banks, including high street lenders like SDFC, ICICI, they all blindly follow that rate, despite having the access to low cost deposits. Now you are also, you have access to low cost deposits. You have spoken about this product differentiation. So when do you think banks will be in a position, or maybe small finance banks can lead the way, that you will dictate the terms and NBFC MFIs will follow your rates to survive in the competition?
I think it was on its way, but COVID actually put a speed breaker on that. So at this point of time, when you have an elevated PAR and elevated NPA, the credit risk premium actually is more. The risk adjusted yield on the portfolio it's not as what the pre-COVID levels are. So till your repayment behavior comes back, till your risk adjusted yield increases, the risk curve actually improves. You might see some kind of an higher rates. So that would take around, my gut feel is around 12 to 18 months is where the risk adjusted yield actually shows a good amount of maturity, comes back to some kind of pre-COVID levels, and so the rates will go down. Parallelly, what's happened is when you increase the ticket size of the loan, you actually you reduce your operational cost. So if you look at microfinance loans, it started from 15, went up to 30, now it's gone up to 50. So there's new regulations. When you increase the ticket size, you actually increase the operational efficiency of the unit. The third is, I think the market's changing to a physical digital model. We still believe with physical touch. I think gradually after technology comes in and the ticket size increases, we will start going to physical digital model. So the 3 vectors will come into play, and where we will see a marked reduction in the interest rates. So the organization which got low cost funds and is able to meet these 3 vectors fast enough, they will cut down the rates. And then the others will have to start from. But the primary would be how to get the risk adjusted yield fast. So your elevated par has to go down, where your risk premium reduces, and then you start reducing the rates.
I would like to ask Mr. Chattopadhyay, do you think after this regulation, you spoken about new loans, old loans, but do you think you are in a better position to analyze the loans after the new set of data coming in?
So, rather than analyze the loans, I think we should be able to analyze the behavior better. Because
But that's a subjective issue, right?
so you have the possibility now to look at a unit that is no longer just the woman borrower. So you can actually try to analyze what is happening in that composite unit, that is the household. Because the household, what we've seen is that what do microfinance borrowers graduate to as non-microfinance products? Not many of them graduate to an unsecured personal loan. They graduate to take two-wheelers. They graduate to take small affordable housing loans. They graduate to take three-wheelers. They will take some form of farm credit. All of these in the household effectively means that there is an opportunity to either forward integrate into the supply chain or backward integrate into what is the production purpose for which the microfinance loan is being given.
Right.
Now, this need will always exist. This need has existed. There is a certain category of lender which has fulfilled that need till now. What was the arbitrage? The arbitrage was that the other category of lender, more of those lenders were earlier looking at a composite microfinance plus consumer credit bureau report and therefore were able to finance this need. Now, because of this nudge, the microfinance companies who actually have the maximum distribution outreach in these households, they no longer have this disadvantage of arbitrage. So what is very interesting for us to be able to observe is to say that is this need continuing, number one, and is the fulfiller of the need, is the composition of the fulfiller of the need changing? That is actually the inflection point if in this business model.
Mr. Tiwari, are you ready to fulfill this need? I know you have issue about qualifying assets, but have you started the process?
I think sector is very much ready for the innovations now, and in next couple of years we can even see the balance transfer in the microfinance loans, where the first next 2-3 years definitely it will be increasing more reach in the rural areas, and unserved population will be served much better. As of now, we are having almost 1/3 unique customer in the sector, where they are having just one loan in their entire cycle. My assumption is that for next 2-3 years, it will be around 45-50% will be there. Means the entire portfolio is concentrated in just 100 districts in the entire country. It means another 500 districts are waiting for us, and this was only because the compressed regulations were there. We were opening our branches only in the areas where the other microfinance institutions were there, where microfinance culture was there. No one was daring to create a microfinance culture in the new areas. Now, I think with the revised regulation, the situation will be improved, and even the competition within these 100 districts where the we are expecting more saturation, more lenders are there. We all are bound to have more innovations. Means this money lenders issue means still they are borrowing from money lenders, but the way Manoj has told that we must have to design some product where they don't need to go to any informal lender anymore. We have a credit history of these customer segment almost for 10-12 years now. The bureau was launched in 2010 and 11. from there onward means there is a history. It is just demonetization and COVID that has impacted a lot. But definitely we are going to settle in next 6 to 9 months. But after that, definitely it will be innovations.
Okay. We think we have very intense discussion so far that has perhaps enriched your appetite for a few questions. Anybody? Let me ask one question to Mr. Tiwari. What is the process of lenders in this? I mean, for example, a borrower, there is a borrower X. There is MFI 1 who is lending to her, MFI 2 who is lending to her. There is a bank who is lending to her, right? Earlier, the bank loan was not captured in when we calculate this indebtedness. Now it is captured. So there is a possibility that a lender, a borrower, who was earlier not thought of as a over-leveraged customer, perhaps she has now turned into over-leveraged customer. So if it happens so, then how will you cut down your exposure? Who will cut down the exposure? It is the MFI or the bank?
The entity who is going to lend further, they have to take the decision. Means if someone is having exposure today, they will wait till the loans are being settled. But one more thing I would like to add here, in microfinance loan pricing, there are several more things are more important for the borrower. It is not just the pricing. It is about how you are servicing them at the doorstep. Some companies, they call them at the branches, the day expenditure on the day of disbursement almost 500 to 700 rupees. Some companies, they are using the digitization way and they are serving at the doorstep, and even they don't ask them to trouble. Even these 500, 700 rupees, in value terms, it is around 2% in the entire loan portfolio cycle. So borrowers, the behavior of the company, the easiness of the process and interest rates, these all things matters for the borrowers. And it may be with revised regulation, the banks and NBFCs, whoever is coming for the loans, again, they have to take decision. If there is already exposure is there, they cannot lend that. After they have to wait for the loan closures, and if the previous company they have disbursed, their application was lodged again and they have disbursed again, they will continue. So it will be fair competition on the ground. Means if I am going to lend the customer of XYZ, definitely I have to offer some better rates to them, some better comfort to them, in place of some better services to them, that some differentiation should be on the ground.
Any questions? No questions.
One question.
Yes, please.
Question is with Mr. Tiwari and Mr. Madhavan, and I need your direction also, sir.
If you can identify yourself, sir.
Hello? Am I audible now?
Yes.
So the question is that in this segment, normally the disbursement is today digitalized. So what I've understood from all the MFIs that 95%, 98 or even up to 100% of the disbursement is through the bank accounts. So when you are disbursing in a bank account, that it means each and every borrower is having a bank account. However, the collection is still 75, 80 or even more in the cash format. So I have two questions, one on the MFI side. So what are the steps are you taking or you are thinking then when it can become the digitalized collection also through the bank account? Second, even in the small finance bank, also do small finance bank or the normal banks doing the collection in a cash format, or small finance bank and the other banks has already started only through the bank account? And last is, sir, RBI is, giving some kind of direction in the future to move to the collections also to the bank account instead of the cash collection over a period of time.
I think industry is moving in a very right direction. 5 years before it was 100% cash disbursement and cash collection. Now it is 100% bank account disbursement, almost 15 to 20% digital collections are there. Company like us, we started our journey 5 years before. Our collections are digitized almost 95% within 1 hour of the collections. We have mapped each and every CSP point of different banks and even utilized every model for the QR code and everything in last 5 years. And that is being replicated all across the country. So what we are seeing that by doing this, even we are increasing the capacity of our loan officers. We are able to reduce risk and also on the other side, increase the time for the loan officers. 1/3 time is just used for the cash counting, collecting and bringing it to bank account and dropping at the bank counters or something like that. So as an industry, we are bound to do that, and many innovations are happening. Banks like you are also developing multiple products, and today we have seen one very good launch of KeyCash and other companies too. They must be doing some very good thing. Once the rural is very much ready to adopt the changes, they are very much ready for the digitizations. And it is just our worry is that with too much digitization, if some frauds are happening, how we are able to manage. Means even these customers are not very much trained in managing their passcodes and QR codes and many more things. So that will take some more time, but as an industry in next 3 to 4 year horizon, we can see that it is almost 90-95% digitized in both way, and it is paperless, cashless, and even faceless after some time. Means that is fate of the sector.
Mr. Madhavan?
I would agree with Mr. Tiwari. Okay, for every customer, when we do a disbursement, we open a bank account. And we create the bank account, and we give the customer a debit card. But still the mindset of the customer is 90% of the withdrawal happens then and there. Because for them, it's that point of usage. Most of them don't keep any savings account balances at this point of time. The collection is still physical. 20-25% of the collection is gone to digital through NASH, or the customers come and give me money in the account, or they can do it through account. So like in our sanction letter, we give a QR code. So they can scan the QR code and directly transfer the money. We've done that activities, and it's a consistent phase-wise growth. COVID actually gave this impetus. COVID was the best time for us to get this digital collection pushed. So it will come in the phases. As rural areas is gone up to 30-35%. Urban has gone up to 30-35%. Rural is still struggling because they still want somebody to come and pick up. Urban areas, the advantage is they don't have time. So they are more prone to do digital. The rural, they still believe people come together, they still want to meet the person. It's a major gradual increase which will be there. Expectation is like within the next 3 to 4 years, we should be at least 65-70% digital collections. Post that, what we need to do is, how do we get out of this face-to-face meeting? So can video calling. So when they meet at a certain meeting centers and we do a video call, and the video call can be recorded. So that my efficiency of my collector actually increases. So it's a gradual improvement which will happen. But digital helps the collection process in such a way that the collection, he saves his travel time and his efficiency to other activities increases. So we are also pushing to do this digital activity so that my operating cost goes down. It's a consistent change which will come through a gradual point of time.
Yeah.
We will not be issuing any guidelines for mandatory, digital collections, but we'll continue to, provide more and more options for online payments. I mean, we already have a lot of options. I need not mention all those, but mandatory collection through online modes will not be there. I mean, we will not be coming out with guidelines.
Yes, sir.
Move on the part of the Reserve Bank of India to issue the guidelines. But the theme of this circular is giving more empowerment to the board, more empowerment to the MFIs to decide certain things, important things, which were mandated earlier. The question is that, of course, the Reserve Bank slowly, strengthening the supervisory and regulatory framework. My point is, when you are giving power to the board and MFI, what are you thinking to strengthen the risk management, risk assessment, risk control, and risk mitigation mechanism of the small and medium MFIs? Are you thinking of anything in that direction?
Your assessment is quite right, that we have given a lot of empowerment to the board. The most important part being freedom to decide their interest rates. I mean, we haven't spoken about it very openly, but then that's the key feature of the regulation. Now you're talking about risk assessment part. Most of these MFIs, I mean, I don't think now we should be talking about MFIs alone, because now when we talk about microfinance, I mean, there's whole spectrum of entities which are doing these microfinance loans. Now, these banks and to some extent larger NBFCs, they already have their risk assessment structures and all. I mean, they will have risk management committee, board committees and all. ALCO will be there, all sorts of things. They will have this, LCRs. I mean, larger entities will have that. Now the question is, what do we do about? Sorry, Gigi, you want to say something? Okay. Now question is, what do we do about smaller entities? See, smaller entities will be dependent to a large extent on their larger counterparts from where they take loans, because their risk not only comes from asset side, it also comes from the liability side. I mean, they are left open to credit risk on one side, and then on the other side they have the market risk because of their varying interest rates for which they are dependent on the larger NBFCs. Now here, the role of SROs is very important. If you know, microfinance is the only sector where RBI has recognized any SRO. Sa-Dhan and MFIN, these are the only two SROs which are recognized by RBI. Not even IBA or FEDI or, no other association is recognized by RBI. Now that only shows how much importance we give to SROs. And one of the expectations from SROs is that they should act as friend, philosopher, guide to their members. Now earlier it was only for MFIs. I mean, we had mandated that every MFI should become member of at least one SRO. So, I mean, mandating entities to become SROs, that was unique in a way. World over, membership is purely voluntary for SROs. So, here the SROs will play now, see, we need a trade-off. I mean, I can go on talking about this, but we need a trade-off. While larger entities can, they can spend their resources, monetary and human and all sorts of resources, for building their risk management structures. But for smaller entities, I mean, they have just few employees who will be working in remote areas. I mean, how do you expect them to have this kind of structures? The only way they can have some good risk management practices is through hand-holding by SROs. And that's why SROs are here.
So you're telling banks also to take a membership of SROs?
No, it's not mandatory. Right now, it's only mandatory for NBFC MFIs to take a membership of at least one of the SROs. It's purely voluntary for all other lenders.
But the point is, I would like to ask Mr. Before I go to you, just one question to Mr. Tiwari. As you a member of the SRO, you have control over NBFC MFIs, but other lenders, banks, small finance banks, NBFC, other NBFCs, you don't have that much of control. So how do you manage your function?
Almost 3-4 years before, we all, even the NBFC MFIs and many other lenders, bank and NBFCs, we signed a common code of conduct for the sector. And that is being well honored by most of the lenders who are working in this sector. And even majority of the banks, they are either primary or secondary member of Sa-Dhan and MFIN both. So if you go by the portfolio wise, almost 90% portfolio of microfinance sector lenders, that is part of at least one SRO, that is in my knowledge. So in this way means either they are banks which have been evolved from the microfinance background, SFBs, they have evolved from the microfinance background, or especially the NBFCs, they have lended to the microfinance earlier and now they are having the microfinance business. And certain banks, they have started their microfinance business. So they all are almost part of the Sa-Dhan and MFIN. So that is quite satisfying, and almost 99 members are there in that particular, those who have signed the Common Code of Conduct.
Right. Mr. Maman.
Thank you. In fact, first of all, I should compliment and thank RBI for making these regulations more, I would say, forward-looking one. Of course, 2012 we had the first set of regulation, which was more of prescriptive nature, but now it's more of a, I would say it's, what do you say, it's activity-based, and that shows that RBI has given a lot of, or has reposed so much confidence in a sector which has evolved over a period of 20-25 years. My question was not that. Actually, my question is to Mr. Sudhir. You were saying about the movement towards collection also going towards digital. I'm sure it is going to happen that. But do you think that even if we reach 100% digital collection, our physical touch can go away? Should you not be regularly in touch with them the way we have been doing now?
No, 100% physical touch will never go away. If you have cycle 1, cycle 2 customers, you would have to have a physical touch because you understand the pulse of the customer when you do them. You still don't have their income level data. Like if you look at mid-size SME, I don't need a physical touch because there are a lot of data points which can be looked at. But for these customers, the physical touch only tells me as to how the customer is going to behave in future, what he's going through some kind of a crisis, the future loan should be given to them, yes or no. So 100% physical touch will still remain at least for till we get a good data points of these customers. And moment the repayment history comes in for at least 1 or 2 cycles, and if they start breaking away from the groups, then you don't need a physical touch. But initial growth will be on a physical touch.
I just want to add one line. I personally feel that it will be increased. As of now, almost during the collection meetings in the group, it is almost 70-80% time is involved in the cash counting and everything. We will be having more time for the personal discussions, and in this way the personal touch may be more increased in that particular time.
Yes, please.
Yeah, hello. Good afternoon. Sorry, I'll keep it short. I know I'm standing between lunch and the session to get over. One quick question. So it was expected by with the new guidelines that with opening up of non-qualifying assets by around 7 to 8 percentage points per the guidelines, there was an expectation that there will be innovation in products, especially for the MFIs. So are we there yet, or are companies working towards that? Have we seen that? What's the plan for MFIs to kind of use that extra headroom available to give better products to their customers? That's my question.
I think from the revised regulation, what we are trying to understand, I was hearing the Deputy Governor a few days before in MFIN's conclave. Directly or indirectly, the central bank, they want to be focused in the microfinance for a couple of years more. And their expectation is it's a time for the product innovation in the sector, and innovate in the microfinance guidelines only, especially for that particular segment, and focus for the increasing the reach in the unreached segment for a couple of years. And after that, if we are able to prove our results and we can say that we have reached almost majority of the masses, definitely regulators, they are they have supported the sector since last 10 years, means in a very different way, giving the license to the banking license, SFB bank licenses, and the new regulations. So definitely that request may be honored.
We can take one last question. Okay, if there is none, then I would like to ask Mr. Sharma. Mr. Tiwari has talked about this qualifying asset norm. What is the regulators thinking about it? They want this to be linked with total assets instead of total loans instead of total assets. What is your thoughts?
Let me explain why we went for total assets rather than going to loans. See, as a regulator, we want entities to lend, so that's the reason why we we said that you give your 75% loans as a percentage of total assets. In the earlier guidelines, we used to have a concept of net assets. There also we saw that, some of the entities, they were keeping cash with banks and all. I mean, I know your question would be, if somebody is in the business of lending, why would the entity keep cash with banks? But then, in practice, we saw that that was happening. So that was the idea why we went for total assets. Now we've got representations from a lot of entities. I mean, I understand that many of the entities will not be achieving that 75% criteria. We are examining that. Let's see, we've got some data. We need to go deeper into that data. We'll examine that. Let's see what happens then.
Okay. We can go on actually because this is a vast subject, but we have to end here. Lunch is awaiting us. I would like to thank you all for coming here to take part in this session. Thank you, our experts. Let's have a big round of applause for our experts. Thank you.
I'll now request Mr. Sadaf Saeed, a member of Sa-Dhan's Board of Directors, to present mementos to our dignitaries. Mr. J.P. Sharma. Mr. Sudhir Madhavan. To Mr. Vivek Tiwari.
Freezing actually.
To Mr. Manoj Sharma. Mr. Subhrangshu Chattopadhyay. Now to our moderator, Mr. Atmadip.
I think it is. Thank you.
Break for lunch. Our next session is at the Sovereign Hall. And the topic is East and Northeast India, Emerging Opportunities and Challenges. We request you all to be there by 2:45.
Thank you. Thank you so much. Thank you, sir.